Dear learners, welcome to the course on Essentials of Financial Management. Today, I am going to discuss the dividend policy and its two very important pillars. Number one, how to design a dividend policy with respect to pattern of paying dividend to the shareholder, and also deciding the form in which dividend should be paid to the shareholders. The first problem of paying the dividend policy in a certain pattern. Now, here pattern refers to the various framework which have been designed by the firm to distribute earning to the shareholder. Here the company can follow a policy of paying dividend where a consistent amount of dividend is paid every year to the shareholder, or company can have a very flexible approach where one year it can follow stable dividend rate policy, or in some other year it may have a policy of not paying dividend at all. So, here these are the points which highlights the importance of dividend policy for every company. This importance may range from the fact that it can have the shareholders trust in the company, which will help company to raise further capital from the market. It can also be guided by the future prospects of the company, the valuation of the equity share in the stock market, the degree of control company wants to retain its own hand, the amount of surplus fund available with the company, and also the taxation policy of the government. So, here on the basis of various form of dividend payment, the dividend policy of a company can be categorized as stable dividend policy, regular dividend policy, irregular dividend policy, no dividend policy, or sometime a combination of regular plus irregular dividend policy. So, here we will start with the stable dividend policy. What do we mean by stable dividend policy? This involves paying a fixed dividend amount regardless of earning fluctuations, and the company would maintain this level at least for some period of time, unless until either the decrease or increase in earning is going to be sustained for a sufficient long period of time. Now, the key characteristics of this company involves the fact like the company would be paying constant dividend even though there is less earning or there is a more earning in the future year. Then this policy would also provide shareholders with certainty of dividend income, because in the case there is a low profit generated from a company, shareholders are relaxed, they are not having any tension whether this year they are going to receive dividend from the company or not. Similarly, during the prosperity, extra earning may be withheld to maintain dividend during the lean year. So, this is giving a flexibility to the management, as company would keep on giving the dividend even there is lesser profit in a year. So, this amount of surplus earning which is going to be accumulated in the firm would help company in satisfying the shareholders during the lean period when the profit of the company is not as good. Now, this can be reflected through a graphical presentation where we can see the earning is fluctuating here over a period of time, but company is going to be consistently follow a certain amount of dividend unless until it is assured of having a permanent increase in the earning potential of the company, and that is why it is called the stable dividend policy. Stable means it is not going to follow a constant rate of dividend, but it would increase the dividend only after it is having a kind of guarantee, or it is going to have a kind of predictability of the sustenance of profit even in the future year. Now, let us see if the stable dividend policy is followed, what benefit it is going to give to the company and also to the shareholder. Now, if the company is giving consistent dividend even during the period profit is either negative or it is lower, it would definitely give a very high credit standing in the market, and this high credit standing in the market would allow company to raise capital from the market, because this is enjoying the confidence of the shareholder. Now, increases share value as investor prefer dividend certainty. So, the valuation for such kind of company would be high in the market, because a shareholder who is more interested in regular income would always place greater amount of confidence in such company. Now, a stable dividend policy is also providing a signal to the shareholder that everything in the company is good and company is enjoying a consistent profitability. Even company is enjoying consistent profitability and it is also having good projects in hand, and this would enable company to do its long term planning, because the surplus profit would be accumulated in the company, which can further be used for investment in the profitable opportunities. But these policies can also be resulting in some kind of dissatisfaction, disadvantageous position for the shareholder. Number one, that company would not be able to follow this policy when it is having a continuous lower profit situation in the future year. And here this requires careful payout ratio planning to remain sustainable. That means when company is increasing the dividend payout ratio, it should keep in mind that this ratio, which is changing from the previous year, can be followed, can be employed by the company in the future year without any kind of tension for the management. Then when the company belongs to such industry which is passing through various ups and downs, or there is a erratic earning movement, then a stable dividend policy becomes very difficult to follow by the company. Now, the second policy is known as a policy of no immediate dividend. What does it mean by no immediate dividend? That means even if profit is there, the company is not going to pay dividend to the shareholder. And it is not surprising, because we know that equity shareholders are not in a position to compel the company to pay dividend if profit is there. Unlike the debenture holders, they have to be satisfied even if there is no dividend paid by the company. But the question arises, what kind of company can follow this dividend policy? Of course, it is the company which is very new in the market, can prefer not to pay dividend, and it is going to accumulate profit for the future requirement. Secondly, even though company is new or even though company is old, but it is having some very good few projects in hand. So, in such case, instead of borrowing the capital from the market, company can decide to retain the profit instead of paying dividend. And shareholders would also not mind, because this future projects would increase the earning prospects of the company, which can result in higher capital gain in the years to come. There can be some class of company which is facing difficulty because of the unfavorable capital market. They may also decide not to pay dividend. They can be companies whose shareholders belong to high tax bracket and prefer future returns over immediate income. Now, let us see the advantage or the merits of this policy. So, it is maximizing fund available for growth opportunities. So, company can feel comfortable that it is not going to the market and can fulfill all its opportunities for investment through the internal funds. Secondly, it is also going to give high return for the shareholders in the long run, and it can also reduce the dependency on the external sources of fund for the company. The demerit of this policy is that it may disappoint the income seeking investor. Who are the income seeking investors? Like the pensioners who think that income can be generated on a regular basis from the dividend of the company. So, they may get disappointed to some extent. Then it can also have negative impact on the share prices, especially shareholders who prefer to give consistent dividend may not like this company and sell their share in the market, resulting in the lower demand and higher supply of the shares. If we want to graphically present this dividend policy, this is the dividend payout ratio and this is the earning of the company. So, plus 5, this is minus 10, but regardless the profit of the company is going to follow a consistent dividend payout ratio. Now, the third policy refers to the policy of regular plus extra dividend. We have seen that there are certain merit and demerit of the stable dividend policy and the policy of no immediate payment. So, company can have a midway by following a policy of regular plus extra dividend. What does it mean? This policy actually is adopted by any company when it is paying constant regular dividend rate plus supplementary payment. That means, it is a combination of a stable dividend policy and the irregular dividend payment policy. So, in such policy, extra dividend are declared when earnings exceed regular dividend requirement, and also this is providing a clear distinction between regular and extra dividend component. So, the regular dividend will remain fixed, but in addition to this, some extra dividend would be paid out to the shareholder. What advantages can be there of this policy? So, number one is this maintains predictability while sharing extraordinary profit. Secondly, it may preserve the credit rating position or credit rating standing of the company, and finally, it can also provide the signal for exceptional performance without long term commitment. So, that means the very high profit in some year can provide some information to the shareholder that this year company has done exceptionally well, and that is why it is sharing the reward in terms of dividend with the shareholder. The company may also face some of the difficulties in terms of unrealistic expectation of the shareholders. Then when company would not pay substantial extra dividend to the shareholders, it can invite negative reactions if extra dividend is not paid to the shareholders. So, a clear cut communication, a careful communication should be given to the shareholders so that they are not confused and they continue to believe in the company. And this policy can be represented as there has to be a stable policy as we have seen, but this can also have some amount of irregular dividend. So, this is the dividend payment which is extra, this is the regular dividend, and so this is the amount which shareholders are going to enjoy as the total dividend. So, this is actually maintaining the confidence of the shareholder, and this is also giving the reward to the shareholder when there is some exceptional profit in the company. Now, there is another policy which is known as the policy of irregular dividend. So, as the name is suggesting, this policy has a feature of varying dividend directly in proportion to the level of earning, and it is based on the principle that dividend should only be paid when there is a guarantee of the earning and also there is a guarantee of the liquidity. It is very common among companies with fluctuating earning or investment needs, because this kind of company would find it difficult to follow the stable dividend policy. So, first advantage of following this company can be seen in terms of alignment of shareholders reward with the actual performance of the company. This can ensure the flexibility in the dividend decision making process, and it can also retain funds during high opportunity period, which is not possible with the case of stable dividend policy. But as far as the demerit is concerned, this policy results in uncertainty and unpredictability of dividend for the income dependent investors. Secondly, it may also pose negative impact on the share price stability, because in the case shareholders do not receive any dividend from the company, may feel dissatisfaction and may sell their share in the market, resulting in lower share price or a bearish trend in the stock market. Then it is also very difficult for investors to plan for their future requirement, as there will be lot of uncertainty and unpredictability as far as the payment of dividend is concerned. So, graphically we can present it in the form, this is the earning, this is the dividend payment, this is the earning of the company. So, this is the EPS, this is the DPS, and we can see that the earning per share is getting reflected in the dividend per share. So, this DPS is fixed as a proportion of earning which can be paid to the shareholder. So, the policy of regular stock dividend can also be discussed here. This is a kind of dividend policy where instead of paying cash dividend, company is paying stock dividend to the shareholders. So, we can also discuss this under the form of dividend which is adopted by the company for its shareholder. Now, on the basis of different form of dividend, dividend may be classified according to the medium in which they are paid. So, here company can pay either cash dividend, stock dividend, scrip dividend, bond dividend, and also sometime property can be paid to the shareholder, though this form is not very much popular in India. So, let us discuss the cash dividend. So, as the name suggests, the cash dividend are by far the most important form of dividend, where cash dividends are paid to the shareholders, and this ensures the income to the shareholders. But there is a caution that only a company with very sound liquidity position can follow the policy of cash dividend. The cash generated by business earning would be used to pay the cash dividend, and sometime company might issue additional stock to use proceeds so derived to pay cash dividend, or bank may be approached for the purpose. So, sometime in order to maintain the track record of paying dividend to the shareholder, company can borrow the fund from the market to pay the cash dividend. Second type of dividend is the stock dividend, or most importantly it is also called the bonus shares. In this form of dividend, the firm issues additional shares of its own stock to the shareholder in proportion to the number of shares that the shareholders held in lieu of cash dividends. So, this stock dividend would not affect cash and earning position of the company, and nor the ownership stockholder is going to get changed or get diluted by issuing the bonus shares, and there will be transfer of amount of dividend from the surplus account to the capital stock account, which is tantamount to the capitalization of retained earning. So, this bonus shares is nothing but the distribution of shares free of cost to the existing shareholder, and in our country the shares are issued in addition to the cash dividend and not in lieu of the cash dividend. Now, with the help of some illustration, I can show you what happens to the balance sheet of a company, especially the liability side, before and after issuing the bonus share. Suppose there is a equity capital of 5,000, whereas this company also have reserves and surplus of 5,000, and this 5,000 paid up capital is distributing at rupees, face value of the share is rupees 100. So, this company has 50 shares of rupees 100 in the form of equity capital, and it is also having a surplus of 5,000 rupees. So, if company wants to issue the bonus shares, after the bonus share have been issued, the equity capital would become 10,000, reserve and surplus will become 0, and instead of having 100 shares, this company would be having 100 shares of rupees 1,000. This company would be having 1,000 shares of rupees 100. So, this happens to the balance sheet before and after issuing the bonus shares. But the net worth of the company, this is very interesting, that net worth of the company will remain unchanged. So, the ownership of the existing shareholder would also remain unchanged. It would not get affected adversely even though bonus shares are issued, because a part of reserve and surplus is capitalized and converted into bonus shares. Now, it is time to look at the usefulness of a stock dividend for a company. Number one, it preserves cash in the company, because instead of using cash or liquid resources of the company to pay dividend, company is using stock dividend. So, at the time it is paying dividend and keeping the investors satisfied, it is protecting its liquidity position of the company. Second, it is maintain shareholder satisfaction. So, every in the situation of stock dividend, the shareholder would not mind even though they are not getting cash dividend. And secondly, it is also going to improve the growth prospects of the company, because this company is going to use this further capital which is transferred from reserve and surplus account to the paid up capital account in the long term projects, improving the earning prospects in the future. It also enhances the internal financing. So, since it is the internally generated resources, the external sources of fund would not be sought by this company. So, of course, preserving the controlling power and also the company saving, company would also be saved from the burden of interest payment if the capital is borrowed in the form of dividend. This increased number of share on account of issuing bonus shares would also increase the marketability of share, because the share prices would remain in reasonable range, making them affordable and accessible by the small and the marginal investors. And by increasing the number of shares, it would also increase the shareholder base, and it would also reduce the earning per share of the company. Now, let us see the usefulness of a stock dividend for the investors. What happens to the investors if they receive a stock dividend in place of cash dividend? So, number one, that their ownership stake will remain unchanged. So, their power to affect the decision making process will also remain unchanged, and there is a high potential for capital gain, because their capital would further be invested in some good projects, improving the future earning and also the capital gain from the company. The stock dividends are currently tax exempted, so they would also not invite any tax liability. Next, the higher future dividend earning is possible when a company maintain its per share dividend, because instead of receiving the dividend on say 500 share as I have shown in the previous example, now they would be receiving the dividend on 1000 share, provided the share or the proportion is maintained with respect to dividend payment ratio. There would be high chances for the shareholder to participate in growth story of the company, because they are indirectly contributing growth prospects by reinvesting their money in the company. And sometimes it is important to adhere to the legal and regulatory framework, and these companies can also do it by paying stock dividend under the section 205 of the Company Act. Now, is it good for the creator also when the company is paying stock dividend instead of cash dividend? Yes, to a great extent the stock dividend is going to help the creators, because every time the creators are interested in the payment of interest and also in payment of the repayment of principal. So, when the liquidity of the company is intact, there are high chances that they would enjoy higher margin safety and also the assurance regarding the payment of interest and also the repayment of capital. So, this is very much beneficial for the creators if the company preserves cash and pays dividend in the form of bonus shares. The next form of dividend is known as a scrip dividend, where the dividend is paid in the form of promissory notes or in the form of a scrip, and this form is adopted when companies need cash generated by business earning to meet future requirement, or they want to withhold the payment of cash dividend because of some temporary shortage of cash. So, in such case company can issue a scrip whereby it promises to pay dividend at a future date, and this scrip may usually have some kind of date of maturity, after which the shareholders can get the dividend paid by the company, and when it is not stipulated, then it is of course at the discretion of the management. The next form of dividend is the bond dividend, where in case of scrip dividend, the dividend are not paid immediately. In bond dividend, as the name is suggesting, company promised to pay dividend at future date in case of scrip dividend, but in case of bond, the company would issue bonds to stockholder in place of cash. So, as a result of it, the company is postponing the dividend payment, but the company would definitely be inviting a long term liability when the bond is used to pay the dividend, because both of these scrip dividend and bond dividend would result in lessening of surplus and in addition to the liability of the firm. So, one in the case of scrip dividend, company would be paying it at some future date, but in case of bond, now company would be having an recurring liability of paying interest and also the principal when it is due. Now, the last form of dividend payment is the property dividend, and here instead of paying dividend in the form of cash or in the form of dividend in the form of bonus shares, company would be using the assets of the company to pay out to the shareholders. And here generally assets which are superfluous for the company or they are not being used currently by the company can be used to distribute in the form of dividend, or they can be used to distribute the dividend whenever they feel that stockholders would like to receive dividend instead of having a preference for the retention. Then sometimes a company may use it, sometimes company can also use its product to pay dividends. This certain product which is being manufactured can also be paid to the shareholder in lieu of the cash or the stock dividend. Then securities or subsidiary owned by the company can also be paid as dividends. So, sometimes a company can have investment in some subsidiary company. So, the shares of those subsidiary companies can be used to pay the dividend. So, now instead of having these shares in the parent company, now the shareholder would also be having the shares of their subsidiary company, but this form is not popular in India. So, these are the different kind of dividend which can be used by the company to satisfy the shareholder by paying dividend, whether it is being paid in the form of cash or it is paid in the form of stock dividend. So, with this we come to an end with the different form of dividend policy, and here we can have a recap of all the things that we have discussed today. The discussion is started with the pattern of dividend payment, where we have seen that the company may follow a stable rate of dividend policy, where it is going to pay different rate of dividend to the shareholder unless and until it is assured of maintaining the same rate of return even in the future year. Then we have seen there is a policy of no dividend payment. Probably the new company or a startup which is of need of the fund can find this policy as a very useful policy. Then we can have a policy where company is paying regular dividend, but in addition to that, when there is a additional profit, it can be shared with the shareholder with the form of regular plus extra dividend. And there can be a policy where the DPS is directly linked with the earning per share of the company. So, here the some percentage is fixed which can be used to pay the dividend to the shareholder. And then second part of the discussion was like what should be the different form of paying the dividend. So, the most important form is cash dividend, where the shareholders are receiving cash, but it is possible for the company who is very sound in terms of their liquidity, or secondly this can be followed by a company which is having very good reputation in the market, having no problem when it wants to issue the share or some other kind of security to raise capital. Secondly, this can also be preferred when the shareholders belong to a very high tax bracket. So, in order to reduce their tax liability, they can they may like not to receive cash dividend from the company. So, this discussion was further enhanced by looking at the different other form of sources of form of dividend policy, like the scrip dividend, the bond dividend, and also the property dividend. So, I hope we have now understand how the dividend policy of the company can have a bearing on the future prospects of the company, its valuation of the company, its capital structure, and also finally the overall performance of the company in the times to come. So, with this we come to an end. Thank you very much. Wish you all the best.